Welcome to the Deep Dive. We unpack complex topics to give you the essential knowledge you need, quickly and clearly.
Yeah, get right to the point.
Exactly. Today, we're tackling something that could, well, genuinely change how you approach buying a home, especially in this competitive market.
It really could.
We're diving deep into the Mortgage Equity Express program.
That's right. I mean, think about it. For so long, if you needed a mortgage, you were kind of at a disadvantage against those all-cash offers, right?
Totally. You find the perfect place, and boom, someone else swoops in.
Exactly. This program aims to level that playing field. It lets you essentially make what looks like a cash offer, even if you are planning on getting a mortgage.
Okay, that sounds interesting, really interesting.
It's a unique solution. So we're going to break down, how it works, what it means for you, the buyer, and what you need to know to maybe use it.
All right, so our mission today, we give you the shortcut to understanding this, the core parts of the Mortgage Equity Express program. Its purpose, the steps, the important things to watch out for.
Definitely the things to watch out for.
And maybe first, let's just quickly clarify some names we'll be using.
Yeah.
Because you'll hear mortgage equity and also mortgage equity partners. Are they the same thing?
Good question. No, not quite. Think of mortgage equity as the partner company, the one who can step in as that cash buyer if needed.
Yeah.
They provide the structure, the safety net.
Okay, the safety net provider.
Right. And then mortgage equity partners is their affiliated lender. That's who you'll actually work with to get your mortgage financing for this program.
Gotcha. So they work together. Mortgage equity is the program strategist. Mortgage equity partners is the lender.
Precisely. They work hand in hand to make the whole thing, hopefully, seamless.
Okay, so with that clear, let's unpack it.
Yeah.
The Mortgage Equity Express program helps people sell and buy, but the really exciting bit, the headline grabber, is the cash offer program part.
Yeah, that's the core of it. And what's so interesting is how it tackles that big hurdle, the financing contingency.
Right. This offer depends on me getting my loan clause.
Exactly. This program lets you submit an offer without that contingency, even though, behind the scenes, you are getting a mortgage.
So to the seller, it looks like a much stronger, simpler offer.
Absolutely. It screams serious buyer, less risk, faster close. In a bidding war, that can make a huge difference.
Okay, that makes sense. But here's what really caught my eye. What happens if, something goes wrong and you can't get that financing finalized super quickly?
Right, because sellers want speed. Well, this is the really unique part. If you, the client, can't get the final loan approval from mortgage equity partners within the seller's time frame.
Yeah.
Mortgage equity itself, the partner company, can actually step in and buy the property with cash as a nominee for you.
Wait, really? They'll actually front the cash?
Yes. It's like having a very well-funded co-signer ready to jump in. It's a safety net for your offer.
Wow. Okay. That gives the seller massive confidence, I imagine. They know the deal will close one way or another.
Exactly. It takes away a lot of their worry about appraisals or last-minute loan issues.
So how do you get into this? What are the requirements for the Mortgage Equity Express program? Is it complicated?
There are definitely key conditions, not hoops exactly, but important steps. First, like we said, you have to apply for and get your financing through their lender, Mortgage Equity Partners.
Okay, that makes sense for integration.
Right. And crucially, you need more than just a standard pre-approval. You need what's called an underwritten pre-approval.
Underwritten? What does that actually mean? Is that different from what most people get?
Oh, yeah, very different. A typical pre-approval is like a quick glance. An underwritten pre-approval means Mortgage Equity Partners has already done the deep dive. An underwriter has reviewed your credit, your income, your assets, basically everything.
So they're already pretty certain about the loan.
Exactly. They issue a commitment letter, usually good for about 30 days, saying they will lend you a specific amount, barring any, major issues with the property itself. It's much, much stronger than a regular prequel.
And I assume you have to be okay with them sharing your info between mortgage equity and mortgage equity partners.
Yes, that's part of it. You authorize sharing things like credit reports, tax info, asset statements, the approval letters. It's necessary for them to coordinate quickly if mortgage equity needs to step in.
Makes sense. Okay, what about the house itself? Can you use this program for any old property, like a fixer-upper farm?
Good question. No, there are limitations. Generally, it's for single-family homes or condos and townhomes with 1 to 4 units.
Okay, standard stuff mostly. What's excluded?
They typically exclude things like big condo buildings over 4 units, foreclosures, short sales, most new construction, larger multifamily places, and yeah, agricultural or very rural properties.
Why the exclusions? Just risk.
Probably a mix of things. Valuation can be trickier, higher risk, maybe doesn't fit their streamlined process. So that charming farm might need a special written exception from mortgage equity. And it has to be in their service area, of course.
Right. So you find an eligible house. You've got your underwritten pre-approval. How does making the offer actually work? Do you just use a normal contract?
No, it's a bit different. Your offer must be written without that financing contingency. That's the whole point.
Right.
And it will include specific documents provided by mortgage equity. Things like a special offer writer, an addendum to the contract explaining the program, and importantly, a proof of funds letter from mortgage equity.
Showing the seller that the cash is there if needed.
Precisely. It backs up the non-contingent offer.
And before mortgage equity actually signs on the dotted line to potentially buy it, you, the buyer, need to put some money down, right?
Yeah.
Escrow funds.
Yes, absolutely. You have skin in the game. You'll deposit an earnest money deposit, and it needs to be at least 5% of the purchase price.
Okay, 5%. That might be higher than usual for some people.
It often is, yeah. Shows seriousness. And sometimes, if your offer is way above what they think it might appraise for, you might also need an appraisal gap deposit.
To cover a potential low appraisal. Got it.
It protects mortgage equity if they have to step in.
Okay, so offer accepted, funds deposited. You're trying to get your final loan approved with mortgage equity partners. What if you just can't? What if the timing doesn't work out? That's when mortgage equity steps in.
That is the moment, yes.
Yeah.
If you can't get your final mortgage approved in time, mortgage equity performs what's called an interim closing.
Interim closing.
Yeah, they actually buy the house from the seller using their cash as your nominee. And critically at this point, your earnest money and any appraisal gap deposit go to mortgage equity and become non-refundable.
Non-refundable. Okay, that's important because they just bought a house for you.
Exactly. They've put their capital out there.
So after this interim closing, mortgage equity owns the house, and you need to buy it from them.
That's right. You and mortgage equity then sign a separate interim purchase contract. They are now the seller. This buys you more time to finalize your mortgage with mortgage equity partners. Once your loan is fully approved and ready, you have the final mortgage closing between you and mortgage equity, and the house is officially yours. It's a two-step close, potentially.
That safety net sounds great, but let's talk risk. What if, after mortgage equity buys the house in that interim closing, you fail to close? Like, you lose your job or just change your mind?
This is probably the most critical risk for the buyer to understand. If you fail to complete the final purchase for mortgage equity, and it's not their fault,
Yeah.
mortgage equity keeps the property, and you forfeit that earnest money deposit and any appraisal gap deposit you put down.
So you could lose potentially 5% or more of the purchase price.
Yes. It's a significant risk. They might, at their discretion, refund any profit they make if they resell it later, minus their costs. But there's absolutely no guarantee. It underscores your commitment.
Wow, okay. That sole discretion is key. So besides the deposits, is there a fee for using this program?
Yes, there is a program fee for the service, for having that cash offer capability and safety net. It'll be clearly shown on your loan estimate and closing disclosure from mortgage equity partners.
And when do you pay that?
It's due at the very final closing, when you actually take ownership of the property. Just signing the initial participation agreement doesn't lock you in, but once you make a binding offer with mortgage equity, you're committed to the terms and the fee if it closes.
Right. One last thing. Can multiple people using this program bid on the same house?
Good question. Yes, it's possible. It's not exclusive. Mortgage equity says they'll present all eligible offers fairly without playing favorites among their clients using the program.
Okay. So wrapping this up, what's the big takeaway for you, the listener? The Mortgage Equity Express program is basically a tool to give you a serious edge.
A huge edge, making a non-contingent offer backed by cash even when you need a mortgage.
It puts you right up there with cash buyers, potentially even ahead sometimes. A powerful solution, especially now.
For sure. But connecting it bigger picture, it's about giving buyers power and flexibility they didn't have. But, and this is the big but, you absolutely have to understand the rules, the process, and especially those financial risks, like losing your deposits if you can't follow through after they buy the house.
Know what you're signing up for, basically. It offers a path, but demands commitment.
Definitely. It's a fascinating innovation, though. Makes you wonder what other parts of buying a home might get shaken up next.
Always something new. Thanks for diving deep with us today.